Hi. Today, I'll show you how you can use PE Valuator's discounted cash flow calculator. The DCF method is a popular valuation technique where we assume that the value of a company is equal to the sum of the present-day value of all future cash flow. You can find the DCF calculator on each stock's page. It conveniently comes pre-populated with free cash flow for the trailing 12 months, as well as future analyst estimates. You can adjust the discount rate and growth expectations to reflect your assumptions. First, let's look at expected growth. Netflix is expected to grow free cash flow per share at a compounded annual rate of 22% for the next 4 years. Beyond these 4 years, we can make our own assumptions. Let's say they'll grow for another 10 years at 14%. Next, we decide on the terminal growth rate. This is the growth rate expected into perpetuity. A good rule of thumb is to have this around average inflation, lower for declining companies and industries, and higher for companies that are still growing after the initial growth phase. We'll set the terminal rate at 7%, which is on the higher end. Finally, our discount rate. This is typically the weighted average cost of capital. However, it's helpful to think of this as a margin of safety. How much a return we expect from our investment for it to be worth the risk. Looking at earnings consistency and the balance sheet can help us decide on a good discount rate. 10% is the average market return. The higher the desired return, the higher margin of safety. We'll set ours to 12%. Although a solid business, Netflix has strong competitors. The calculator adjusts the fair value in real time, so you can easily see the valuation. We hope you find our DCF calculator helpful. See you next time.